You just got some RSUs in your E-Trade account because they just vested. Your employer withheld 22%, maybe more. You thought you were done with taxes, then you sold some shares 6 months later, and suddenly you owe thousands of dollars more than what you expected. Here's the reality most tech pros miss. Vesting is just one event. Number one, the real story, the one that determines your final bill, unfolds when you decide to sell those shares. And timing matters, holding period matters, your total income in that sale year matters, and almost no one is explaining the complete timeline. Hi, I'm Jonathan Nagy, founder of Alpine Road Financial, and I help tech professionals navigate IPOs and RSU liquidations. And today, I'm breaking down the complete tax line from grant to sale so you can plan moves that minimize your bite and maximize your freedom. So chapter 1 is the tax event 0. So let's start at the beginning. Your company grants your RSUs. Maybe it's your new hire package. Maybe it's that annual refresh because you've been kicking butt. On grant day, nothing happens tax-wise. 0. The IRS, well, it doesn't care yet because you don't own anything. You just have a promise from your employer that if you stick around and hit certain milestones, you'll eventually get shares. But here's what you need to do. Write down 3 things: your grant date, your number of units, and your vesting schedule. That grant date starts your personal equity calendar. It is going to be the baseline for everything that follows. When you owe taxes, when your holding period begins, and when you can start planning. Think of the grant like a contract signing. You just agreed to the terms, but no money has changed hands yet. No taxable event, just, well, a starting line. So chapter 2 is the tax event 1, the vest. So let's fast forward to vesting day. This is where the IRS starts to wake up. On the day your RSUs vest, the shares become yours. And the IRS treats that transfer exactly like if your employer handed you a bucket of cash for a bonus equal to the fair market value of those shares. Here's the math. Let's imagine 500 shares vest on March 15th, 2026. When your company's stock prices closes at $80, the fair market value equals 500 shares times 80, which is $40,000. Well, that $40,000 gets added to your W-2 as ordinary income, which is taxed at your marginal tax rate. Could be 24%, could be 32, could be 37, depending on your total compensation. Your employer knows it's coming, so they withhold. The federal default is 22% for supplemental wages under $1 million. So on that $40,000 vest, they'll withhold $8,800 federal, plus another 7.65% for FICA, which is Social Security and Medicare, plus whatever your state wants. In California, tack on another 9 to 10%. In Oregon, maybe 9%. In Texas or Washington, 0 state tax. So most companies handle withholding through sell to cover. They sell just enough of your vested shares to pay the tax bill. Then they deposit the rest into your brokerage account. You might vest 500 shares, but you only see 350 or so hit your account after withholding. That's normal. But here's the critical piece. That 22% federal withholding is often way too low. If you're already earning $250K in base salary and you vest another $200K in RSUs, you're going to be deep into that 35 or 37% tax bracket. Though withholding covers just a part of it. But come April, you could owe thousands of dollars more. This is why high earners with big events need to make quarterly estimated tax payments, or they need to jack up their W-4 withholding to avoid penalties. The fair market value vest, that $80 per share in our example, becomes your cost basis. Memorize that number. It is the foundation for the tax event 3. So chapter 3 is tax event 2, which is the sale. Now you got shares in your brokerage account. You're stoked. You paid ordinary income tax on the full value at vest. The question is, when do you sell and what's the tax consequence? This is where holding period matters. The IRS draws a bright line at year 1. If you sell shares within 1 year of vesting, any gain, which is the difference between your sale price and your cost basis, is going to be taxed as a short-term capital gain, which means ordinary income rates all over again. But if you hold longer than 1 year from vest date, you qualify for long-term capital gains treatment, which can be 0, 15, or 20% depending on your income. So let's walk through another hypothetical example. You vested 500 shares on March 15th of 2026 at $80. Cost basis is $40,000. You've already paid ordinary income tax on that $40,000. Scenario A, you sell all 500 shares on September 1st of 2026, which is 5.5 months later. Stock price is now $90. Sale proceed is $45,000. Your gain is $5,000 because you sold within 1 year vesting. That $5,000 is short-term capital gains, which is going to be taxed at your ordinary rate. If you're in the 32% tax bracket, you owe another $1,600. Scenario B, you hold those shares to March 16th of 2027, which is 1 year and 1 day after vesting. The stock is now $95. You sell for $47,500. Your gain is $7,500. But this time, it's all long-term gains. If your total income puts you in that 15% long-term capital gains bracket, you owe $1,125 instead of that $2,400. That patience saved you over $1,000. Scenario C, the stock drops. You sell in October 2026 at $70. You actually have a $5,000 capital loss. You can use that loss to offset other gains. Maybe you sold some winners earlier in the year, or you can deduct up to $300,000 against your ordinary income and carry forward the rest into future tax years. This is tax loss harvesting, and it's a powerful tool. The holding period clock starts at vesting, not at grant, and that's the common mistake. Your grant might have been 2 years ago, but if those shares just vested last quarter, your holding period is brand new. Chapter 4 is calculating your gain or loss. Let's make sure the math is crystal clear. When you sell vested RSU shares, your taxable gain or loss equals the sale price minus your cost basis. The cost basis is the fair market value on the vesting date. It's the same number your employer reported as income on your W-2. Well, some brokerages report your cost basis as 0 on the statement, which panics people. But that's just for reporting quirk. Your actual cost basis is the fair market value at vest. So double check your records or look at your W-2 from the vesting year. The equity income line will show the value that was taxed. That is your basis. Here's a worked example. You vest 1,000 shares at $50 fair market value. Your cost basis is $50,000. 6 months later, you sell 300 shares at $60. Proceeds, $18,000. Basis on those 300 shares is $15,000. The gain, $3,000 short term. Now, if you're in the 24% bracket, you're going to owe $720. What if the stock tanks? You invest 50 and you sell at 40. That's a $10 per share loss. On 300 shares, that's a $3,000 capital loss. You can either offset gains or deduct $3,000 against ordinary income this year. And that can save you up to $1,110 if you're in the 37% tax bracket. The IRS, well, doesn't care whether you're happy or sad about the stock price. They just want the math. Sale minus basis equals gain or loss. Report it on your Schedule D. All right, Chapter 5 is how sale timing interacts with your marginal tax bracket. Here's where it gets strategic. Your RSU sale gains don't exist in a vacuum. They stack on top of your W-2 income, your bonuses, and other investment income. That stacking can push you into higher brackets. Or, if you're smart, you can time sales in lower income years. Let's imagine you're married, filing jointly. Your combined W income is $350,000. You're solidly in that 24% ordinary bracket for 2026. but you also have $100,000 invested RSU shares with a $20,000 embedded gain. If you sell all those shares this year, that's $20,000 of short-term gain gets taxed at 24%, costing you $4,800. But what if next year you take a sabbatical? You had enough, you need a break. Well, your income drops to $150,000. Suddenly that same $20,000 gain is taxed at 22%, saving you $400. Or better yet, if you waited for long-term treatment and your income qualifies, you might just pay 15% long-term capital gains, which is $3,000 instead of $4,800. That is why bunching matters. If you know you're switching jobs, taking a parental leave, or launching your old thing, consider delaying RSU sales into lower income years. The marginal rate difference compounds fast when you're liquidating six figures. Now, the flip side, if you're expecting a big raise, a promotion, or just another massive vest, sell winners this year before your bracket climbs. So chapter 6, advanced strategies, bunching sales, and tax loss harvesting. Once you understand the timeline, you can get surgical. Two tactics I use with clients constantly: bunching sales into strategic years and harvesting losses to offset gains. Bunching, well, it's simple. Instead of selling a little RSU stock every quarter to diversify, you concentrate sales in years when your income is lower. Maybe you defer your bonus. Maybe you max out your 401k to pull down your taxable income. Maybe you're just between jobs. That is your window. Liquidate the shares you've been sitting on, capture long-term gains at the lowest tax rate possible, and rebalance your portfolio without a giant tax hit. Tax loss harvesting is the flip side of this equation. Let's say you sold 500 RSU shares for $15,000 of short-term gain. You're staring at a $5,550 tax bill at 37%. But you also own some index funds in your taxable brokerage that are down $10,000 this year. Sell those losers, lock in the $10,000 loss, and offset your $15,000 gain. Now, your taxable gain is just $5,000 and your bill drops to $1,850. You just saved $3,700. You can reinvest the proceeds from the tax loss harvest in a similar but not identical fund to stay in the market and avoid a wash sale. Just don't rebuy the exact same security within 30 days, or the IRS will disallow the loss. Here's a pro move. At year end, review your total gains and losses. If you're sitting on big gains, look for losers to harvest. If you got big losses, maybe realize some winners to use up the loss without paying tax. It's simply a balancing act, and it takes a little bit of planning, but it can save you 5 figures pretty easily. Chapter 7 is the real scenario. 200K vested, quarterly sales, year-end math. So let's tie it all together with a real-world example. Meet Alex. Hypothetical, but this mirrors clients I work with. Alex, well, he's a senior engineer at a late-stage tech company. Total W income, $250,000 base salary. In 26, Alex vests $200,000 in RSUs across 4 quarterly vesting events, which is $50,000 each quarter at varying share prices. Q1 vests $50,000 at $100 per share. Withholding, 22% federal, which is $11,000, plus 7.65% FICA, $3,825, plus 9% state, which is $4,500. Net proceeds after sell to cover roughly $30,675 worth of shares deposited. Through all this, cost basis per share, $100. Now the Q2 vest, 50,000 shares at $110 per share. Same withholding period, cost basis $110. Q3 vest, another 50,000 shares at $95 per share. Cost basis $95. Q4 vest, another 50,000 shares at $105 per share. At the end of the year, Alex's W-2 shows $250,000 salary plus $200,000 of RSU income for a total of $450,000 of ordinary income. Federal withholding from salary and RSUs, roughly $80,000. Now, Alex is married filing jointly, so taxable income after standard deduction is around $417,800. That puts Alex in the 35% tax bracket for the top slice. But here's the kicker. RSU withholding was just 22%. Alex actually owes 35% on a big chunk of the RSU income. The shortfall is about $13,000. If Alex didn't make quarterly estimated payments, there's going to be an underpayment penalty coming. Now Alex decides to sell half the vested shares. Let's say the Q1 and Q2 vest in December of 2026, which is 8 months after vesting. Stock price at sale, $115. Q1 shares basis, $100. Sale, $115 a gain per share. Q1 shares basis of $100. Sale, $115. So the gain is $15 per share. Well, as Q2 shares, basis $110. Sales still $115. Gain is $5 per share. Total short-term capital gain, about $10,000. Tax at 35%. That's another $3,500 owed. If Alex had waited until April of 27, just 4 more months, those gains would flip to long-term tax at 15% instead of 35%. The bill would drop from $3,500 to $1,500. That is a $2,000 savings for holding a few extra months. This is why timeline matters. Every decision, when to sell, how much to sell, and whether to harvest losses compounds. The complete picture isn't just pay taxes at vest, because it's vest, then it's hold or sell, then it's calculate gain or loss, then it's layer that on top of your total income, and then it's true it up at year end. Hey, it can get pretty complicated and you've earned your equity. Don't let taxes or timing take it from you. I've helped tech pros navigate IPOs, RSU lockups, and stock windfalls with confidence. With experience myself at companies like Apple and Square, I'll help turn your equity into lasting freedom with no surprises. If you want more trail days and less tax stress, let's talk. Visit the link in the description below to book a strategy call or download my free RSU tax checklist so your equity doesn't surprise you come tax time.